Hey hamsters, the financial world has had its share of highs and lows, but few events have shaken it like the couple of financial crises that have been sprinkled in the last decade. Much like a hamster hitting an unexpected dead end in a maze, everything stalled. But the scariest part, not knowing who will end up taking the biggest hit or how long the crisis will last. Join us this week's Academy as we explore the top 3 biggest financial crises in history and how they came about. Sunflower seeds ready?
Are you ready, kids?
To preface this Academy, it makes sense to start the discussion with what makes a financial crisis a crisis. These 3 events can all be linked to a sudden breakdown in the hamster tunnel system, causing chaos and major losses everywhere. Asset prices tank. Businesses and consumers find themselves in deep debts they can't repay, and financial institutions find themselves in a liquidity shortage. So now, when hamsters think of a financial crisis, they are often quick to associate it with a panic of investors selling off assets for fear they will drop further. But what spurs on the panic? This might stem from any number of reasons, whether it is a systematic failure, uncontrolled human behavior, the incentive to take on excessive risk, like taking out loans to buy stocks, the absence of regulation, and even pandemic viruses. With this in mind, let's look at our top 3, starting at number 1. The stock market crash of 1929 of the Great Depression. Turning back the clock to October 29th, 1929, we arrive at the first major crisis in today's Academy. The 1920s, which were also known as the Roaring Twenties, were a period of major economic growth in the United States. When things were good, everyone began investing in the stock market. It became somewhat of a hobby for those who could afford it, and for those who couldn't, buying stocks on margin became more popular. This practice involved buying an asset and only paying a percentage of the asset's value. The rest of the money was borrowed from the bank or the broker, and as a result, margin credit increased from 12% in 1917 to 20% in 1929. Of course, with so much optimism, remember this was right after World War I, companies were also gambling on good vibes, which resulted in oversupply across many industries. Companies were getting more money for cheap since share prices were high and they could keep investing in their own production. Of course, at a certain point, there was too much stuff.
Stop it. Get some help.
And companies had to dump their products at a loss, share prices tanked, and of course, everyone who invested saw their savings wiped out. Rounding out the event was the 4 business days, Black Thursday, October 24th, through Black Tuesday, when the world spiraled downward into the Great Depression. We can liken this series of events to hitting the biggest bump on the hamster track, by far the worst financial and economic disaster of the 20th century. The Depression rolled on for nearly 10 years, leaving a trail of lost income, record unemployment, and a massive drop in production, especially in industrialized countries. By 1932, stocks were only worth about 20% of their value in the summer of 1929. And at its peak in the US in 1933, almost 1 in 4 people found themselves without a job, a staggering 25% unemployment rate. The Great Depression came to an end with World War II in 1939, when the US went to war, shifting the economy to a war economy, with many getting jobs in the defense industry or going overseas to fight in the war. However, recovery was not instant. In fact, the Dow Jones Industrial Average did not return to its pre-1929 heights until November 1954. 25 years later. Holding the coveted number 2 spot after the Great Depression is the Great Recession. Stemming from risky loans and questionable borrowers, the financial crisis of 2007 and 8 was like a hamster wheel suddenly spinning out of control. The Great Recession lasted several years and is now considered to be the most significant downturn since the Great Depression. a result of a lack of regulations in the financial industry. Prior to the Great Recession was the 2001 dot-com bubble burst and the terrorist attacks on September 11, 2001. This was, to put it lightly, not great for the US economy, and in response, the Federal Reserve, aka the Feds, decided it would be best to cut interest rates to help stimulate the economy.
Why?
With low interest rates and federal policy that encouraged home ownership, there was a boom in real estate and an expansion in mortgage debt. Releases like subprime and adjustable mortgages also came into the picture, making it even easier for borrowers to get home loans based on the belief that interest rates would stay low and home prices would continue to grow. Naturally, this was not the case, and interest rates went up instead. Borrowers couldn't afford these rates and things started to take a turn. Now, looking back, economists are quick to attribute the Great Recession to a failure of the Federal Reserve in stopping banks from giving mortgages with low rates to people who had bad credit and could not repay these loans. Eventually, these became a drop in housing prices, a major sell-off, and many without a home. But of course, this wasn't it. This took down one of the biggest players in the investment banking game, the Lehman Brothers, which was exposed as having a portfolio worth a lot less than people had thought. Naturally, clients began to abandon Lehman. Its stock price plummeted and creditors would not bail the bank out. As the fourth largest investment firm, at one time holding $600 billion in assets, this was a pretty severe hit. This meant that in response, the government had to step in with massive bailouts just to keep things from totally collapsing. The recovery took almost a decade, erasing millions of jobs and billions in income as economies struggled to get back on their feet. COVID-19 Pandemic. Rounding out the third stop is the recession triggered by the COVID-19 pandemic, which we can liken to a sudden wall in the hamster maze.
Coronavirus!
According to the CD Ho Institute, this pandemic-fueled recession ran from March 2020 to 2021, making it the shortest but deepest economic downturn since the Great Depression. What kicked this event off was a fast-spreading virus that resulted in mild to moderate respiratory illnesses and could be spread very easily. Countries shut their doors and their citizens were forced to stay home, forcing businesses everywhere to close up shop, which in turn sent economies spinning. The S&P 500 index, the benchmark for stock market performance, fell a whopping 34% between February and March 2020. The good old GDP in the early part of the pandemic fell 9% below what it was at the start of the recession, which for context was a steeper decline than the nearly 4% drop in the worst part of the Great Recession. Traders were also reported to lose hope, believing the situation could end up worse than the economic climate of 2007 and 8. Fortunately, governments and central banks stepped in to support these economies with stimulus packages. Companies learned how to move a lot of their work online wherever possible, birthing a new digital workplace, and the restrictions that were once in place on economic activity were eventually lifted. The result? Stock prices saw a turn for the better.
Whoever you are, thank you.
And the market once again recovered. And that wraps up our trip through the three biggest financial crises in history, hamsters. Thanks for joining today's Academy. Subscribe and remember, hamsters have power. One for all and all for one. Bye!